Governments around the world desperately need someone,
We need someone authoritative and reassuring.
anyone,
Anyone?
to buy their growing mountains of debt. But with investors growing cautious and central banks wary of printing yet more money, policymakers are stuck between a rock and a hard place. We're told there are only two options: inflate away the debt or default. But there is a third option, one with a long history: financial repression. In today's video, we'll explain exactly what financial repression is, what to expect from it, and how you can weather the storm and thrive during this turbulent era. My name is Guy, and this is a video you can't afford to miss. Now, to truly understand what's unfolding in global markets today, we need to unpack a policy that's as old as modern finance itself: financial repression. And few explain it better than financial historian Russell Napier, whose work provides the backbone for today's video. If you've watched our previous deep dive on Napier, then you'll know his framework is key for decoding what's happening right now. If not, then the link to that video is right over here. So then, what exactly is financial repression? Well, at its core, it's a toolkit of government policies designed to make public debt easier to manage, without resorting to politically toxic options like massive tax hikes, severe spending cuts, or excessively inflationary money printing. Instead, governments use more subtle levers to borrow at interest rates that are artificially low, often lower than the rate of inflation. This means that the real value of what's owed shrinks over time, while the real value of savings quietly erodes. But it isn't just about keeping rates low either. Financial repression is a much broader regime. It includes directing banks, insurers, and pension funds to buy and hold government bonds, even when those bonds offer returns that can't keep up with rising prices. Through regulation, incentives, or outright mandates, governments create what Napier calls captive markets for their own debt. At the same time, restrictions on capital movement, whether explicit capital controls or more subtle obstacles, make it hard for investors and companies to send their money abroad in search of better returns. And the impact is anything but theoretical. To see financial repression in action, look no further than the decades following World War II. Countries like the United States and the United Kingdom managed to bring down their post-war debt mountains dramatically, not by defaulting or slashing budgets, but by holding interest rates below inflation year after year. In the US, for example, the debt-to-GDP ratio fell from more than 100% in 1946 to under 25% by the early 1970s. This was achieved not through painful defaults or rapid growth, but because savers and pensioners lost purchasing power as the government gradually paid down its debt with money that was worth less and less each year. It's important to understand, though, that this playbook worked in a very different era. Back then, economies were heavily regulated, capital couldn't move freely across borders, and financial markets were relatively insulated from global shocks. Today, however, the financial system is hyper-connected and digitized, meaning that while governments are reaching for the same tools, the effects and risks could be even more unpredictable. That makes the return of repression more complex, with new risks and the potential for unintended consequences. As Napier points out, policymakers in advanced economies are dusting off the old tools, interest rate suppression, regulatory mandates, and inflation, as public debts reach new heights not seen outside of wartime. But why now? Well, it's not just a question of technical necessity. After the global financial crisis of 2008 and the shock of the pandemic, public borrowing has soared across the developed world. Governments are desperate for a solution that avoids inflicting pain directly. As a result, we're seeing a return to subtle but powerful financial repression, regulatory tweaks, pressure on banks and funds to absorb government debt, and inflation that isn't simply an accident, but an unspoken part of the plan. With most of these mechanisms invisible to the average saver. And by the way, if you're enjoying this video so far, then be sure to smash that like button to help give it a boost. And if you haven't already, subscribe to the channel and ping that notification bell so you won't miss our next upload. Okay, now that we've explained what financial repression is and why it's making a comeback, let's dig into Russell Napier's roadmap for what happens next, and why this era is so different from anything most investors have experienced before. Napier's central argument is that we're living through a profound shift from monetary dominance to fiscal dominance. For decades, central banks were the main actors in global markets, raising or lowering rates to guide inflation and stimulate or cool economies. But as government debt loads reach staggering new heights, the responsibility has shifted. Fiscal policy, meaning government budgets and deficits, now holds the real power, with central banks increasingly forced to follow the lead of political decision-makers. Now, this shift is critical because today's governments are deeply reliant on continuous deficit spending to support aging populations, maintain social programs, fund defense, and try to keep economies growing. In this environment, making meaningful spending cuts is all but politically impossible. And so, governments will do almost anything to keep borrowing costs low and avoid the pain of making big spending cuts or raising taxes. That means financial repression becomes the tool of choice, not because it's optimal for growth, but because it's politically survivable. So, how will this play out? Well, Napier predicts that regulatory pressure on institutional investors, think pension funds, insurers, banks, etc., will ramp up substantially. And we're already seeing evidence of this in Europe, where government debt is classified as risk-free and banks are encouraged, by design, to load up on sovereign bonds. And as fiscal pressures mount, these regulations could become even more explicit, turning private savings into state financing on an unprecedented scale. Napier calls this the, quote, politicization of savings, where what should be private investment choices are redirected by the government to prop up public debt. And a clear real-world example is Japan, which could very well be the first developed economy in the modern era to openly cross into financial repression. For years, the Japanese government has relied on low rates and a massive homegrown investor base to finance its enormous debt. But with traditional buyers like pension funds and insurers growing wary, the pressure is mounting for policymakers to ensure demand for government bonds, even if it means using new regulations or direct pressure to make domestic institutions and corporations absorb more public debt. Recent moves by the Bank of Japan, along with encouraging more bond buying, suggest Japan may soon formalize this policy shift. And if you want a closer look at how this story is unfolding, then check out our deep dive on Japan's bond chaos right over here. And it doesn't stop with the financial sector either. Napier warns that as fiscal dominance grows, we should expect a creeping return of capital controls, barriers that prevent wealth from escaping to safer or higher-yielding havens abroad. This could include outright limits on money flows, tighter reporting rules, or even restrictions on alternative asset classes. It might seem impossible in today's globalized world, but history shows that desperate governments always find ways to trap capital when pressure mounts. Napier goes further, though, arguing that this time governments may not just allow inflation to drift higher, they could quietly target and sustain much higher rates as well, perhaps in the 4 to 6% range. It's a strategic move designed to shrink their debt burden without explicit fiscal pain. But, as Napier warns, trying to fine-tune inflation is dangerous. Once expectations change, inflation can quickly get out of control, creating risks that spill over far beyond just government balance sheets.
Apologies for the interruption, folks, but I very quickly want to tell you about the Coin Bureau deals page. Now, if you're interested in things like discounts on hardware wallets, money off trading fees, and exchange sign-up bonuses, then the Coin Bureau deals page is absolutely the place that you need to check out. The link is in the description below. These are some of the best deals and promos in all of crypto. So Check it out when you have a moment. Okay, enough from me, back to the video.
Now, as the machinery of financial repression grinds on, the question every investor should be asking is, who comes out ahead and who gets left behind? One thing that's clear by now is that financial repression fundamentally reshapes the investment landscape, quietly punishing some assets while opening up rare opportunities for others. So let's start with the losers. The most at risk are traditional savers and anyone relying on fixed income strategies. In a repression regime, interest rates are deliberately held below inflation, sometimes for years. If you're holding cash, savings accounts, or classic government bonds, the numbers on your statement might look stable, but the real value of your money is being steadily eroded. Savers, pensioners, and anyone on a fixed income find their purchasing power shrinking, and the so-called risk-free asset becomes, in effect, a guaranteed way to lose money. But the ripple effects go further. For banks, insurers, and pension funds, the real pain isn't just about being forced into government debt. It's that their business models come under sustained pressure as their returns erode and their ability to innovate or provide meaningful yield to clients shrinks. Rather than building wealth for their clients, they end up helping the government raise money, forced to follow rules that put government needs ahead of profit. This means that for clients, especially those relying on traditional wealth management, there's less room for optimism. The usual ways to grow your money just don't work as well anymore. But what about equities? Well, here Napier sounds a note of caution, especially for those heavily exposed to large cap index funds or the kinds of stocks that dominate passive portfolios. Why? Because when financial repression reaches its tipping point and asset managers are forced to reallocate into government bonds, broad-based selling can hit the biggest, most liquid stocks the hardest. And this creates an environment where being passive, just buying the index and waiting, could backfire. But it's not all doom and gloom. There could also be clear winners. Hard assets like gold, commodities, and real estate have traditionally offered strong protection in eras of financial repression. These assets can keep pace with or even outstrip inflation. During the great liquidation of post-war debt, gold prices soared as trust in fiat currencies waned. Commodities and property offered not just a store of value, but a way to hedge against the relentless erosion caused by negative real interest rates. And Napier also points to select equities as potential beneficiaries too, specifically companies positioned in sectors that align with government fiscal priorities. So think infrastructure, defense, and energy. These industries often see public investment ramp up during periods of high government spending, while other parts of the market stagnate or shrink. Now, here's where things get truly interesting. In the modern era, crypto and stablecoins add a whole new chapter to Napier's playbook. Stablecoins, for example, are often backed by government debt, the very assets that governments want everyone to own. If you watched our video on stablecoins as America's bailout plan, you'll know that stablecoins are essentially a stealth extension of financial repression, as buying them has the effect of subsidizing government borrowing. Yet, as government bonds become more tightly controlled, stablecoins like USDC could become increasingly important tools for both governments and the financial system. If interest rates remain high, but governments need to suppress borrowing costs, then stablecoins may be leaned on as quiet demand for government debt, especially in the US and EU. But what about other cryptocurrencies? Well, in this environment, the biggest beneficiaries are likely to be those that offer genuine decentralization, like Bitcoin and Ethereum, since they operate beyond the reach of traditional financial controls. When trust in banks, central banks, or even government bonds begins to erode, these digital assets can become alternative stores of value, potential lifeboats in a world of financial repression. And we've already seen signs of this, with Bitcoin actually rising during the banking turmoil of 2023. So, if financial repression is such a tough break for savers and market participants, then what alternatives do governments actually have? Well, there are a handful of classic routes out of a debt crisis, but none are easy, and most are even less politically palatable than the slow burn of financial repression. So the first option is fiscal consolidation, what most of us know as austerity. This means governments slashing spending, raising taxes, or indeed both, to try and bring deficits back under control. Now, in theory, it's the most direct and honest path, but it turns out to be very unpopular at the ballot box. With aging populations demanding more from public programs and political polarization at record highs, few leaders are willing to risk their careers pushing through deep spending cuts or tax hikes, which is why it's pretty much off the table in almost every major economy. The second path is debt restructuring or outright default. Now, this is the nuclear option for governments, admitting they simply can't pay what they owe and negotiating new terms or simply walking away. Napier and many other financial historians note that while defaults are not unheard of, they come with severe consequences, namely plunging credit ratings, capital flight, and often social unrest. For advanced economies, default remains the last resort, one that governments will delay at almost any cost for as long as financial repression can buy time. Then there's the market-friendly option, economic liberalization and growth-oriented reform. History shows that when governments open up markets, cut red tape, and foster innovation, growth can help whittle down debt to GDP ratios without painful sacrifices. But today's political environment is not exactly right for big bang reform. There's not much interest in loosening the rules, and powerful groups often stand in the way of big changes. So, a fourth option is international coordination. In an ideal world, major economies could agree to coordinate monetary and fiscal policies, smoothing out the global shocks that make financial repression so tempting. But given today's geopolitical tensions, fragmentation, and rising nationalism, real, effective coordination is likely not on the horizon. Instead, what we're seeing is more divergence, not less, making each country's path even more dependent on domestic politics. Napier's view is that while other paths exist, none are as quietly effective or as politically survivable as financial repression. It's the path of least resistance, the one that hides the costs and spreads the pain so thinly over time that few even notice it's happening. So then, given everything we've covered, what can you actually do to protect and position yourself in this new era of financial repression? Well, first, let's address the market sequence Napier sees ahead, because your strategy needs to be shaped by how this story unfolds. Unlike past crises, Napier doesn't predict a dramatic sudden crash like in 2008. Instead, he expects a so-called market melt-up. In the early phases, abundant liquidity and negative real yields will push asset prices, stocks, property, and even crypto higher as investors scramble to outrun inflation and government debt suppression. Each dip will be met with sharp rallies, creating the illusion of unstoppable momentum. But eventually, as regulatory mandates and political pressures build, the rules change. Asset managers, especially the big institutions, will be compelled to buy ever larger quantities of government bonds, meaning they'll need to sell off equities and risk assets to make room. This sets up a drawn-out period of forced rotation in which capital is steadily siphoned out of the private sector and absorbed by the state. The result won't be a sudden market crash, but a slow, grinding decline in asset prices, a bear market engineered not by panic, but by regulatory design. It's this dynamic that makes passivity more dangerous than ever. For traditional investors, the lesson is simple. Don't underestimate the impact of inflation on your wealth. Sticking with cash or bonds that pay less than inflation is a recipe for quietly losing purchasing power. As mentioned before, this is an environment that calls for moving away from major indices and bonds and towards hard assets and select value or infrastructure stocks. Diversification is also critical. By spreading assets across different geographies and markets, you lower the risk of being trapped by any single government's policies. History has shown that rules can change overnight, and jurisdictions that once seemed safe may not remain so. For the crypto investors amongst us, the stakes are equally high, but play out on different fronts. Financial repression often triggers speculative surges in alternative assets as capital seeks refuge, and we've already seen crypto act as a lifeboat during periods of macro stress. But Napier's warnings about regulatory pressures shouldn't be ignored. As governments fight to maintain control, expect more attempts to regulate, monitor, or even restrict crypto activity, especially around stablecoins. So, prioritize self-custody and security, and remain agile. Be ready for periods of sharp rallies as liquidity chases returns outside the mainstream, but don't be caught off guard by new rules or coordinated attempts to limit capital flows in and out of digital assets. Above all, Napier's main lesson applies to both traditional and crypto investors. Don't trust that what worked yesterday will work tomorrow. Financial repression is a slow-moving regime change, not a one-off event. Those who are willing to diversify, stay alert to inflation, and embrace both hard assets and new financial instruments like crypto will be the best positioned to protect and potentially grow their wealth as the landscape evolves. So, if there's one thing to take away, it's that being passive is now the greatest risk of all. Those who adapt early, who recognize the warning signs, will have a clear edge. In a world where stealth taxes are the new normal, being proactive is not just prudent, it's essential. And that's all for today's video, folks. If you want to know why globalism is collapsing and how to survive the upcoming era, then check out our dedicated video on it right over here. And if you haven't subscribed to the channel yet, you can do that down there. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.